The stock market took off like a rocket today and hit its all-time high when the Fed announced that it was doing nothing. I know that sounds crazy, so today I'm going to explain in simple terms why that happened and what to expect going forward. In 2022, inflation and interest rates hit their highest levels in decades. I know you felt the impacts of that in your personal life. Well, it wasn't fun for us, and it wasn't fun for the stock market either. You see, the stock market hates high interest rates for two reasons. First, it hurts companies' profits because it makes it more expensive for them to borrow money and grow their business. And two, it makes the guaranteed return on safe investments like money market funds better compared to the uncertain returns of the stock market. Put simply, if you expect the stock market to earn a long-term return around 10%, that's a lot more attractive when the alternative is only paying you 1% than it is when the alternative is paying you 5%. So what's getting the stock market all giddy is not necessarily that the Fed decided to keep interest rates where they are, it's that they said they expect to lower interest rates 3 times in 2024. Just like you and I, the stock market is really tired of this high inflation and these high interest rates. So it gets excited when it thinks they're going down. But at what point does it become overexcited? That's what we're gonna get to at the end. But before we get there, we have to understand why the Fed might lower interest rates next year. You see, the Fed raises rates to fight inflation and lower rates to stimulate the economy. But what few people understand is that it's actually the real rate that determines how restrictive or stimulative interest rates are. The real rate is the interest rate minus inflation. And in normal times, they like it to be at roughly 0.5%. So that means if inflation is at 2%, the neutral real interest rate would be 2.5%. When the real rate is higher than 0.5%, aka there's a bigger gap between interest rates and inflation, that slows the economy down and lowers inflation. So since they expect inflation to fall to 2.4% next year, keeping rates at 5.5% would imply a 3.1% real interest rate, which would be very restrictive and almost certainly push us into recession. So it's a balancing act. If inflation falls to 2.4% like they expect, they'll want to lower rates so they don't push us into a recession, but not lower them too much since they'll still want them to be a little bit restrictive to get inflation back down to their 2% target. And by the way, this is exactly what I predicted in my Inflation Outlook 2024 video a month ago. I think there's a strong case to be made that inflation will fall back to around 2% in 2024 with or without a recession. I think they would likely cut rates by a lot, and we could get to a 2.5% Fed funds rate in 2025. So here's where we get into what to expect going forward. I'll dive deeper in my 2024 Outlook videos on the stock market, the bond market, and the housing market, but here's a little taste. I think investors might have had a little bit of selective hearing when it came to the news today. They heard inflation is falling and interest rates will likely come down. But they seem to have ignored the comments about how the Fed expects the economy to slow down and the unemployment rate to go up. In 2024, investors are expecting a world where inflation and interest rates are falling. We don't have a recession and companies' earnings grow at 10%. Put simply, they're expecting everything to go right. And on top of all that, the stock market is expensive right now, even based on those lofty expectations. A key thing to remember is that the stock market always prices in what is expected to happen in the future. So it rallied today and it's been up about 15% in less than 2 months because of these rosy expectations. However, I think it's much more likely to go one of 2 ways, both of which would be a disappointment for the stock market. The first scenario is one where we do get falling inflation and interest rates, but company earnings do not grow as fast as expected. Since the economy is expected to slow down, the unemployment rate is expected to go up, and they plan to keep monetary policy tight, it's not exactly a stretch to think we could fall short of those expectations. If we do, stocks will likely fall, especially because they're already priced for perfection, in my opinion. The other scenario is that we do have a strong economy and earnings growth, but we do not get the falling interest rates the market is so giddy about because inflation stays higher than expected. That would also likely disappoint investors and cause the stock market to go down. I actually think the first scenario is more likely. Is the rosy outcome that investors are expecting actually possible? Yes. However, in my opinion, it's already priced in, which means it has to happen just to keep the market where it is. For the market to go up from here, things have to get even better than the rosy scenario that's expected, aka already priced in. It's always possible, but the higher your starting expectations, the easier it is to leave disappointed. It's kind of like when your friend tells you about a new restaurant that's going to be the greatest thing you've tasted. Even if it's pretty good, you still might leave a little disappointed. I think investors are about to sit down at their table, but I'm not sure the meal will be as good as advertised. Now, if you want more on why I think inflation will fall in 2024, check out my Inflation Outlook 2024 video. I'll put it somewhere on the screen, and click that subscribe button because Outlook videos for the stock market, bond market, and housing market are all coming by the end of the year. And if you want to join my free Discord for more investment insight, check out the link below in the description.